Engines roar, assembly lines pulse, and pickup trucks roll off factory floors at relentless speed. But behind the noise and chrome, pressure is building inside the balance sheet of Toyota Motor Corporation. The world sees durability, resale strength, and brand loyalty. What investors and suppliers must see is tightening capital efficiency, rising global competition, and a truck strategy that is more exposed than it appears. Toyota trucks have long been considered anchors of profitability. Models such as the Tundra, Tacoma, and Hilux carry strong margins in North America, Australia, Southeast Asia, and the Middle East. These vehicles are marketed as indestructible tools for contractors and families alike. That reputation has allowed Toyota to command premium pricing. However, premium pricing depends on stable consumer confidence and affordable financing. Both pillars are now under strain. Interest rates across major economies remain elevated compared to the previous decade. Pickup trucks are expensive assets. The average transaction price for full-size trucks has climbed dramatically, and financing costs now add thousands of dollars over the life of a loan. For Toyota, this means demand elasticity is increasing. When monthly payments rise, loyalty erodes. Consumers who once defaulted to Toyota are now cross-shopping domestic competitors or delaying purchases entirely. The problem is magnified by Toyota's aggressive capital allocation into electrification and hybrid systems. While Toyota was cautious compared to pure electric startups, it still committed billions to battery plants, supply chain partnerships, and platform redesigns. Those investments must generate returns. Yet the global electric vehicle market is cooling from its initial surge. Incentives are shrinking in some regions, and infrastructure growth has slowed. If hybrid and electric truck adoption fails to scale quickly, Toyota will carry high fixed costs without proportional revenue growth. Truck manufacturing is capital intensive. Retooling factories for new platforms requires billions in upfront investment. Depreciation schedules stretch over years, but cash outflows are immediate. If truck volumes soften even modestly, operating leverage turns against the company. Margins compress faster than revenue declines. This is where historically strong brands can become vulnerable. A 10% drop in truck sales does not translate into a 10% drop in profit. It can translate into a 30% decline in operating income for that division. Dealer networks are another pressure point. Toyota dealers depend heavily on truck sales to maintain profitability. Trucks drive financing income, service revenue, and accessory sales. If inventory builds because consumers hesitate, dealers are forced to discount. Discounting weakens residual values. Lower residual values increase lease costs, and higher lease costs reduce demand further. This cycle feeds itself. Residual value deterioration is not theoretical. As more competitors flood the market with advanced driver assistance systems and performance upgrades, the perception gap narrows. If used truck prices fall sharply, Toyota's reputation for value retention will erode. Once that perception breaks, it is difficult to rebuild. Consumers buy trucks partly as financial assets. If they fear accelerated depreciation, purchase decisions stall. On the supply side, Toyota trucks rely on a complex global web of suppliers. Semiconductor shortages exposed how fragile that web can be. Although chip supply has improved, geopolitical tension and trade friction remain. Any renewed disruption would again restrict output, while fixed costs remain. Toyota's balance sheet is stronger than many peers, but resilience is not immunity. Cash reserves can shrink quickly during sustained production volatility. Labor costs are also rising. Wage negotiations across North America have reset expectations within the auto industry. Even manufacturers with non-union plants must raise compensation to remain competitive. For trucks built in high-wage regions, cost per unit increases can squeeze margins if pricing power fades. Toyota cannot assume it will always pass costs to consumers without consequence. Furthermore, competition in the pickup segment is intensifying. Domestic manufacturers are investing heavily in technology, towing capacity, and interior refinement. New entrants from China are exploring export markets with lower-cost electric pickups. While Toyota benefits from global scale, scale alone does not guarantee dominance in a rapidly evolving segment. there is also the strategic tension between global and regional priorities. The Hilux is a workhorse in emerging markets where price sensitivity is acute. The Tundra and Tacoma compete in North America where consumers demand size and power. Developing separate platforms or heavily modifying shared architectures increases complexity and cost. If Toyota misjudges demand in any region, it risks excess capacity in one market and shortages in another. Liquidity risk is currently moderate, not acute. However, refinancing pressure cannot be ignored. Automotive manufacturing depends on access to credit markets for both corporate funding and consumer financing arms. If credit conditions tighten further, Toyota Financial Services divisions could face higher borrowing costs. That would translate directly into more expensive loans for truck buyers, amplifying demand risk. The truck business has been a pillar of Toyota profitability, but pillars can crack when weight increases. Capital intensity, competitive pressure, and macroeconomic headwinds are converging. Investors must examine whether truck margins are sustainable under prolonged stress, rather than assuming past performance guarantees future resilience. Please subscribe to our channel. We want to hit 1,000 subscribers this week. Consumer Red Alert. For consumers, the risk profile of Toyota trucks is not about imminent disappearance from showrooms. It is about financial exposure tied to ownership. When a brand enters a period of margin compression and strategic strain, consequences filter down to buyers in subtle but meaningful ways. First, pricing discipline can shift. If Toyota faces inventory buildup, incentives may rise temporarily. That can appear beneficial to buyers. However, incentives often signal weaker resale values ahead. Early adopters who purchased at peak pricing may see equity evaporate. Negative equity traps consumers in longer loan terms and limits their flexibility. Second, cost-cutting measures may surface. When manufacturers seek to defend margins, they scrutinize supplier contracts and component specifications. Even minor material changes can affect long-term durability. Toyota's reputation has been built on reliability. Any erosion in perceived quality would have disproportionate reputational impact. In the truck segment, durability is not optional. It is the core promise. Third, service networks can feel strain. Dealers operating under tighter margins may reduce staffing or delay facility upgrades. Parts availability can fluctuate if suppliers renegotiate terms or exit unprofitable contracts. For truck owners who rely on their vehicles for income, downtime is more than inconvenience. It is lost revenue. Warranty reserves are another indicator to monitor. If claim rates rise or if new technologies introduce unforeseen issues, Toyota may need to increase provisions. That directly affects profitability and signals engineering risk. Hybrid systems integrated into trucks add complexity. Complexity increases the probability of defects during early production cycles. Insurance costs are also evolving. As trucks incorporate advanced electronics and driver assistance systems, repair expenses increase. Higher repair costs translate into higher premiums. Consumers should evaluate total cost of ownership rather than focusing solely on sticker price. There is also geopolitical exposure. Toyota's global footprint means that currency fluctuations can influence pricing. A weaker yen can support export competitiveness, but volatile exchange rates create planning uncertainty. Consumers in import-dependent markets may face abrupt price adjustments. For fleet buyers, risk multiplies. Large construction and logistics firms purchasing dozens of trucks depend on predictable operating costs and resale values. If secondary market prices weaken or maintenance complexity increases, fleet economics deteriorate. Fleet managers must stress test assumptions under scenarios of lower residual values and higher financing rates. Another red flag is strategic distraction. Toyota leadership must balance investments in autonomous driving, battery technology, hydrogen research, and traditional combustion engines. Capital spread across too many initiatives can dilute focus. If truck platforms do not receive adequate investment, competitors can leap ahead in innovation cycles. Bankruptcy risk for Toyota in the near term remains low relative to smaller manufacturers. The company retains significant scale and liquidity. However, risk is relative, not absolute. The automotive industry has shown that dominant players can experience rapid valuation compression when profitability narratives shift. Credit rating downgrades, if they occur, would raise borrowing costs and signal deeper concern. Consumers should also watch for production pauses, delayed model refreshes, or abrupt strategy shifts. These are often early indicators of internal reassessment. A canceled or postponed truck program can reveal capital constraints or demand miscalculations. From a practical standpoint, buyers considering a Toyota truck should evaluate timing carefully. Purchasing during periods of elevated incentives may provide short-term savings, but long-term value depends on residual strength and brand stability. Leasing may reduce exposure to depreciation risk, but lease terms must be scrutinized for realistic residual assumptions. In summary, Toyota trucks remain formidable products in capability and heritage, yet financial gravity applies to all manufacturers, regardless of reputation. Mounting capital expenditure, competitive saturation, financing headwinds, and global uncertainty create a complex risk landscape. For investors, the key question is whether truck profitability can withstand prolonged macroeconomic pressure without eroding cash reserves. For consumers, the key question is whether the purchase aligns with realistic expectations about depreciation, maintenance, and financing costs in a higher rate environment. The truck may start every morning, the engine may sound confident, but beneath the hood of the corporation, strain is accumulating. Those who ignore early warning signals often pay the highest price. Please subscribe to our channel. We want to hit 1,000 subscribers this week.